Welcome to this explainer. Today, we are putting on our analytical hats, sitting down as an investment committee, and conducting a masterclass level teardown of Community Trust Bancorp, ticker symbol CTBI. Now, we're not just glancing at standard metrics here. We are going to pressure test this stock using the exact frameworks of legends like Warren Buffett, Peter Lynch, and Benjamin Graham, before we cap it all off with modern quantitative models like a DCF. So, if you've ever wondered exactly how the greatest investors of all time evaluate a regional bank stock, well, you are absolutely in the right place. Let's get to it. Here's our roadmap for the analysis. We're starting with a quick CTBI snapshot, then moving through the Buffett, Lynch, and Graham lenses, followed by our DCF and alternative models, and wrapping up with our final synthesis and recommendation.
All right, let's jump right into part one, the CTBI company snapshot. So, Community Trust Bancorp is a solid regional bank operating primarily in the Appalachian region. Taking a look at the core data, the stock is currently trading right near a 52-week high at $74.63, which gives it a market cap of about $1.36 billion. Now, you might be wondering what's driving that high price. Well, they just reported a record-breaking quarterly net income of $29.6 million. That works out to a highly impressive $1.64 per share for the second quarter alone. And yet, even with that record performance, the stock is still trading at a pretty modest PE ratio of just 13.13.
But honestly, what's most fascinating on the fundamental side is this single number right here, 45. That represents 45 consecutive years of cash dividend increases. I mean, just think about that for a second. Through the dot-com bust, the 2008 financial crisis, recent inflationary spikes, through all of that, this management team has maintained the absolute discipline to consistently raise that payout. That immediately flags this as a highly disciplined institution with incredibly stable earnings. Moving on to Section 2, the Warren Buffett lens. Let's see how the Oracle of Omaha would view this. We all know Buffett demands a moat. He wants a business fortress that competitors just can't reach. Now, CTBI is the third largest Kentucky-domiciled bank holding company, and they command massive regional deposit market share across their footprint. So sure, it's not a global mega bank, but inside its specific Appalachian geography, CTBI has an entrenched, formidable advantage that acts as a very real economic moat. Looking at the balance sheet, Buffett loves companies that generate high returns on equity, but without using a ton of leverage to get there. Comparing his targets to CTBI's reality, the bank posts a very healthy return on equity of 12.27%, well above his standard baselines. But here's the real kicker. They achieve this with an insanely conservative debt-to-equity ratio of just 0.08. This totally satisfies Buffett's strict preference for downside protection and bulletproof balance sheets. Finally, Buffett values the business based on what he calls owner earnings. Now, as you know, banks are tricky because they don't have traditional free cash flow. Cash is literally their inventory. So we have to make a slight adjustment here. We're assuming their trailing 12 months net income of roughly $103 million as a proxy for owner earnings. And considering that 45-year dividend streak and record Q2 profit, these earnings are as predictable as they come, meaning it passes the Buffett test with flying colors.
Let's shift gears to Section 3, the Peter Lynch lens.
Peter Lynch famously categorized companies to set clear expectations. He would look at CTBI and instantly categorize it as a stalwart. Basically, a slow, steady grower that gives you reliable protection when the market gets ugly. With a PE of 13.13 and assuming a modest historical growth rate of under 10%, we get a PEG ratio, that's PE divided by growth, of roughly 1.3. So no, it's not some screaming bargain on a growth basis, but it is an incredibly sturdy defensive hold, backed up by a super strong tangible common equity ratio of 11.94%. And here's something Lynch would absolutely love: the ownership structure. He always looked for stocks Wall Street was ignoring. Right now, CTBI has 60.2% institutional ownership and 2.6% insider ownership. For a $1.3 billion company, a 60% institutional holding actually means it's not overly crowded by the massive mega funds. It passes Lynch's test perfectly, a quiet, under-the-radar regional stock where retail investors can actually still find an edge.
Now stepping into the shoes of the godfather of value investing himself, Section 4, the Benjamin Graham lens.
Graham was notorious for his ruthless defensive investor checklist. Let's see how CTBI holds up. Adequate capitalization over $500 million? Easily, it's at $1.36 billion. Strong financials with low debt? Check. Exceptional earnings stability and a 45-year dividend record, massive checks there. And lastly, Graham demanded a PE under 15 and a price to book under 1.5. CTBI sits comfortably at a 13.13 PE and a 1.2 price to book. I mean, it literally aces the entire checklist. So this brings us to the ultimate Graham test, his famous intrinsic value formula. He built this to find a hard, cold, objective target price based purely on physical book value and current earnings, completely stripping out market emotion. The formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share. Let's actually run the numbers. We extract the estimated trailing 12-month EPS of $5.68 and our calculated book value per share of $62.19. We plug those right into Graham's formula, and look at this. It spits out an intrinsic value of $89.15. This is absolutely wild, because at the current price of $74.63, Graham's famously strict formula is telling us the stock currently offers a 16% margin of safety.
Okay, leaving the historical gurus behind, let's look at modern corporate finance in Section 5, DCF and alternative models. Let's walk through the discounted cash flow math. Step 1. We assume our $103 million net income proxy grows at a very conservative 5% for the next 5 years. Step 2. We calculate a terminal value, assuming the bank essentially settles into a 2% perpetual growth rate, which basically just matches long-term inflation. Step 3, we discount all of those future cash flows back to today using a 10% weighted average cost of capital.
But hey, no model is a crystal ball, right? So we ran a sensitivity matrix on those assumptions. Our base case scenario, right smack in the middle, yields a fair value of exactly $85 per share. And even if you tweak those assumptions up or down slightly, the model consistently points to healthy upside from where it's trading today. Now, when we apply alternative valuation models, things get really interesting. A strict dividend discount model actually punishes the stock, valuing it down at $47.11. Why? Because that specific model struggles with high-yield, low-growth regional banks. But on the flip side, a comparable PE analysis, assuming a historically normal 15x multiple on that $5.68 EPS, aligns almost perfectly with our DCF, handing us a fair value of $85.20.
We've got all our data. Let's pull it together in Section 6, Synthesis and Recommendation.
Look at this summary lineup. It tells a remarkably compelling story. Aside from that overly pessimistic dividend discount model, the current market price of $74.63 is sitting comfortably below the fair value ranges we got from Graham's formula, our DCF, and comparable multiples. Across 3 very different frameworks, the math clearly points to undervaluation. But we have to weigh the scales fairly here. The committee's final debate really highlights CTBI's pristine balance sheet, a massive 1.56% return on assets in the first quarter, and its literal dividend royalty status. But on the other side of the coin, the risks are real. Geographic concentration purely in Appalachia, being stuck in Lynch's slow-growth stalwart bucket, and of course the general macroeconomic headwinds that always threaten regional banks. So, blending Buffett's mode analysis, Lynch's categorization, Graham's rigorous math, and our modern DCF modeling, our final verdict? This is a buy for yield and value investors. The fundamentals are just too strong to ignore. Now, if you wanted to achieve that absolute, perfect sleep-at-night margin of safety that the gurus demand, waiting for a slight dip to a trigger price of $70 would make this an unassailable, screaming buy. As we wrap up this explainer, I want to leave you with one final provocative question. Right now, the broader market is desperately chasing these volatile tech trends and hyper-growth unicorns. But ask yourself, is the real blueprint for compound generational wealth quietly doing its thing, hiding in plain sight, right here in a highly disciplined regional bank? Thanks for joining me on this deep dive. And as always, keep doing your own rigorous analysis.